The S&P 500 just hit a critical wall at 588. If the bulls don't hold this line, this ceasefire rally is a total trap.
Technical strategist Matt deWolf of Trade Brigade joins a heavy-hitting lineup, including Gareth Soloway and the Doomberg team, to reveal why the charts are signaling a massive regime shift.
We've used advanced AI to distill over 5 hours of deep-dive expert analysis into these high-signal minutes, giving you the alpha without the fluff.
Get ready to learn why gold is finally breaking its dollar chains, how a private credit earthquake is surfacing, and which energy signals are predicting the next food crisis.
The lead-off story today is the big ceasefire news in the Middle East, causing a massive gap up across the indices. Matt deWolf points out that we are looking at roughly a 1% jump at the open.
Exactly. Matt deWolf emphasizes that while news drives the gap, the technicals tell us if it stays. We are seeing a swipe right toward that critical resistance at 588.
Wait, so a ceasefire happens and my portfolio just goes up 1% instantly. How does that work?
It is all about uncertainty leaving the market. When risk drops, buyers step back in. But Matt warns, we need to see if this is a gap and go or a gap and crap scenario.
Matt deWolf is keeping a close eye on whether today becomes a true follow-through day or FTD. If we close strong, it confirms the recent bottom.
Right, and FTD usually happens 4 to 7 days after a low. It is the green light for bulls to stop hiding in the bushes.
Hold on, FTD. Is that like some secret trader code for buy everything now?
Sort of. Matt describes it as the moment of validation. Without it, this gap up might just be another trap for late buyers.
Matt deWolf's thesis is clear. The 588 level on the S&P 500 is the line in the sand. If we stay above it, the bulls take control.
He notes that we've seen heavy supply there before. If we can't clear it today, we might just fill the gap and head lower.
So if it hits 588 and stops, I should be worried.
Matt suggests that would be a classic failure to launch. We want to see a sustained move with volume to believe this rally is real.
According to Matt deWolf, the QQQ is fighting its own battle at the 20-day EMA, which is sitting right around 498.
That's a major overhead hurdle. Matt mentions that the tech heavyweights need to pull their weight if we're going to break through.
Wait, EMA? Is that like an average price or something?
Exactly, it is the exponential moving average. It acts like a ceiling. Matt's data shows that if we can't close above it, tech might stall out.
Matt deWolf highlights Nvidia as the market's backbone right now. It is holding steady above $140.
He observes that as long as Nvidia stays north of 140, the broader market has a fighting chance.
So Nvidia is basically the captain of the ship. If they sink, we all sink?
Pretty much. Matt calls it the canary in the coal mine. If 140 breaks, look out below.
Matt deWolf doesn't mince words on Summaries. He calls it a complete battleground with wild volatility.
Is that the one with all the accounting drama? Why would anyone touch that?
Exactly. Matt warns that unless you're a professional scalper, it's a dangerous place to park your money right now.
He's watching the $35 level there, but honestly, his analysis suggests most people should just watch from the sidelines.
Matt deWolf predicts that if SPY fails to hold 588, we are looking at a gap and crap where we fade all day.
He's skeptical because the volume often dies out after these news-driven morning spikes.
So the crap part is when all my gains from the morning just disappear by lunch.
You got it. Matt's reasoning is that without new buyers, the early gap longs will just start taking profits and drive the price back down.
Looking at crypto, Matt deWolf sees Bitcoin testing $91,000 as a key psychological level.
91,000? Man, I remember when it was like $10.
Matt thinks if it clears 92,000, we could see a quick run back toward 100,000, but it has to hold the 91 line first.
It's all about momentum there. If the stock market rally sticks, Bitcoin likely follows suit.
Matt deWolf's main advice is to wait for the first 15 minutes of trading to settle before jumping in.
He wants to see if the opening high holds. If we break above the 15-minute high, that's your signal to go long.
So I just sit on my hands for 15 minutes? That feels like an eternity in the market.
It saves you from getting chopped up in the morning noise. Matt's strategy is all about patience over FOMO.
Finally, Matt deWolf says to watch the DXY. If the dollar stays strong, it makes it harder for stocks to rally.
Why does a strong dollar hurt my stocks? Shouldn't a strong dollar be a good thing?
Generally, a stronger dollar makes corporate earnings from overseas worth less when converted back. Matt uses it as a secondary confirmation.
If the dollar drops while stocks gap up, that's the Goldilocks scenario Matt is looking for.
The single biggest alpha from Gareth Soloway's latest chat with Michelle Makori is this. Gold has officially broken its leash. It no longer needs the US dollar to crash to reach new all-time highs.
Exactly. Normally, if the dollar is strong, gold is weak. But Gareth points out that gold is hitting records while the dollar index stays remarkably resilient.
Wait, I thought they were like a seesaw. If one goes up, the other has to go down, right?
Usually, yes, but Gareth says we're in a new cycle where global fear and central bank buying are overriding that old rule.
Which means if the dollar ever actually does drop, gold might just go vertical. But we have to look at the S&P 500 risks first. Gareth Soloway isn't just guessing. He's looking at a massive breakout on the monthly charts above $2,075.
That level was a triple top resistance for years. Gareth calls it a power move now that we've closed above it.
So, 2075 is the magic number. If it stays above that, we're golden?
In technical terms, yes. That previous ceiling has now become the new floor for this rally.
And Gareth notes that this isn't just retail hype, it's institutional accumulation.
Michelle Makory and Gareth discussed how central banks bought over 1,000 tons of gold last year alone.
1,037 tons, to be exact. That is the second highest annual purchase on record.
Hold on. Why are governments hoarding gold like they're preparing for the apocalypse?
They're diversifying away from the dollar. If countries like China and Russia stop buying treasuries and start buying gold, the demand surge is permanent.
It creates a supply squeeze that retail investors are only just starting to notice. Gareth also compared Bitcoin to gold, and honestly, his take might surprise the crypto fans.
He likes Bitcoin, but he thinks gold is the ultimate safety net when the S&P 500 finally corrects.
So he's saying gold is the adult in the room when markets get messy.
Exactly. Bitcoin is still trading like a high beta tech stock. Gold trades like, well, gold?
He's watching for a specific Bitcoin pullback if the stock market takes a 10% hit. Everyone is waiting for the Fed to cut rates, but Gareth thinks the market is overestimating how much they can actually do.
Right? If inflation stays sticky, the Fed can't pivot without sparking a massive price spiral.
Wait, so if they don't cut rates, doesn't that hurt gold?
Gareth's point is that gold is now rising because of inflation fear rather than rate cut hope. It's a huge shift.
Essentially, gold wins if the Fed fails to control the narrative. Gareth's chart analysis suggests we're looking at a move toward $2,500 or even $2,800.
And he's not talking about 10 years from now. He thinks this cycle is accelerating.
2,800. That's like a 30% gain from here.
It is. And he bases that on the measured move from the previous multi-year consolidation pattern.
If the cup and handle pattern plays out, those numbers are actually conservative. The flip side of Gareth's bullishness on gold is a serious warning for stock investors.
He's predicting a 15 to 20% correction in the S&P 500 as the everything bubble meets reality.
20%? My 401k is going to feel that one.
That's why Gareth is rotating into hard assets. He thinks the risk to reward in tech is terrible right now.
When the panic starts in equities, the flight to safety in gold becomes a stampede. The main takeaway from Gareth and Michelle's discussion is to stop obsessing over the dollar index.
Watch the relative strength. If gold stays flat while the dollar rises, that is an incredibly bullish signal.
So if the dollar is winning and gold isn't losing, gold is actually winning.
Exactly. It's showing that buyers are stepping in regardless of the currency headwind.
Finally, monitor that $2,075 level. As long as we stay above it, the bull market is intact.
Gareth suggests using any dips back toward that level as potential entry points for a long-term position.
Got it. Buy the dip, watch the floor, and ignore the dollar noise. I can do that.
Just remember, Gareth says the charts don't lie, even when the headlines do. Today, we're diving into a heavy-hitting discussion between David Lin and the team at Doomberg regarding why our markets are more fragile than ever.
The alpha here is simple but terrifying. Energy is the master resource, and Doomberg argues we are entering the biggest energy shock in human history.
Wait, biggest in history? Like worse than the 1970s?
Potentially. Because this time it's not just oil, it's the entire infrastructure of how we produce and move power.
And while energy prices are the immediate fire, Doomberg teases a secondary crisis in global food supplies that will break down shortly. Doomberg's core thesis is that the global energy transition is hitting a wall of physical reality, requiring $100 trillion in new investment.
Exactly. You can't just flip a switch to green energy when the physics of energy density don't match the demand of a modern economy.
100 trillion? That's not a real number. How are we supposed to pay for that?
That's the point. We can't, at least not without massive inflation or a total breakdown of the current system.
So basically, we've built a fragile house of cards on cheap energy that doesn't exist anymore.
Great. So the lights stay on, but my bank account goes dark.
Looking at the data David Lin and Doomberg discussed, European natural gas prices saw a spike of 1,000% at their peak.
And Doomberg points out that the US is not immune. As we export more liquefied natural gas, our domestic prices are becoming tethered to global chaos.
Hold on. 1,000%? My heating bill is already annoying. I don't need 1,000% increase.
It's the Europeanization of energy. When you rely on overseas markets, you import their volatility.
So our energy independence is more of a marketing slogan than a physical reality right now.
So we're exporting our cheap gas and keeping the high prices for ourselves? Brilliant.
Doomberg also highlights the diesel crisis. U.S. inventories plummeted to just a 25-day supply at one point.
That's the fuel that moves every truck, train, and ship. If diesel runs out, the economy stops in its tracks.
25 days? That sounds like a countdown to an apocalypse movie.
It's close. High diesel prices add a hidden tax to every single item you see in a grocery store.
And Doomberg argues this isn't just a temporary glitch, it's a lack of refining capacity that takes years to fix.
So things aren't just expensive because of inflation. They're expensive because the trucks are paying double for fuel.
Doomberg makes a critical link between energy and food. 70% of the cost of fertilizer is natural gas.
This is why the energy shock is so dangerous. High gas prices mean less fertilizer, which means lower crop yields next season.
Wait, so energy prices are literally going to dictate how much food is on the shelves?
Precisely. Doomberg calls it the molecules to calories pipeline. You can't have one without the other.
It's a domino effect that most Wall Street analysts are completely ignoring while they stare at interest rates.
Can we go back to when the only thing I had to worry about was the price of a Netflix subscription?
Based on the conversation with David Lin, Doomberg predicts oil will likely sustain levels above $90 per barrel.
They argue that underinvestment in fossil fuels over the last decade has created a permanent supply floor.
$90. I remember when it was 40. Is this the new normal?
It is if we don't start valuing reliable energy over political promises.
So basically, expect to keep paying a premium at the pump for the foreseeable future.
My bicycle is starting to look like a very smart investment.
One of Doomberg's darkest predictions is the deindustrialization of Europe, with some sectors already seeing a 20% decline.
When energy becomes too expensive, factories just shut down and move to the US or Asia.
A 20% drop? That's not a recession. That's a collapse of their entire industry.
Exactly. Doomberg warns that Germany, the engine of Europe, is essentially unplugging its own economy.
And if Europe goes down, the global supply chain for high-tech components goes with it.
So we're watching a slow-motion car crash across the Atlantic.
Doomberg suggests investors watch the crack spread, the difference between crude oil and refined product prices.
If that spread stays wide, refiners are printing money, but consumers are in for more pain.
The crack spread? Sounds like something I'd need a chemistry degree to understand.
It's just refinery profit. High spreads mean a bottleneck in turning oil into gasoline and diesel.
So keep an eye on tickers like VLO or PSX to see how the industry is actually performing. Finally, Doomberg advises monitoring fertilizer companies like CF Industries and Mosaic as proxies for natural gas stability.
Their stock prices will tell you more about the future of food inflation than any government report.
So, if the fertilizer guys are struggling, my grocery bill is going up in 6 months.
You've got it. It's the ultimate leading indicator for the real economy.
Keep your eyes on the molecules, not just the digital digits on a screen.
Understood. Molecules over money. Well, both if possible.
Jeff Snider is sounding the alarm today because Moody's just downgraded the outlook for Oaktree specialty lending from stable to negative.
That's OCSL for the ticker watchers. Their non-performing loans or non-accruals spiked from 2.4% to 4.2% in just one quarter.
Wait, 4.2%. That doesn't sound like a disaster, but Jeff is making it sound like a 5-alarm fire. Why?
Because it nearly doubled in 3 months. In the world of massive credit funds, that kind of move is an earthquake.
And while OCSL is the headline, Jeff warns this is just the tip of the iceberg for the whole $1.7 trillion private credit market.
1.7 trillion. Okay, now I see why we're talking about this. What's the second shoe that's about to drop?
Jeff Snider's core thesis is that private credit isn't the safe haven investors thought. It's just shadow banking without the safety nets.
Exactly. The $1.7 trillion market grew because people were running away from traditional banks, but the risks just followed them there.
So it's like moving your money from a leaky bucket to a slightly newer bucket that's also starting to leak.
Precisely. Jeff argues that higher interest rates are finally catching up to the middle market companies that these funds lend to.
They have floating rate debt. When the Fed hiked rates, their interest payments exploded, and now the cash is running dry.
And if they can't pay Oaktree, Oaktree can't pay its investors. I'm starting to see the problem.
Jeff highlights a major red flag called PIKE, or Payment in Kind Interest. It's basically a buy now, pay later scheme for corporations.
Instead of paying interest in cash, these struggling companies just add the interest to the total balance of the loan.
Hold on. So they're paying off their debt by taking on more debt. How is that even allowed?
It's a feature of private credit contracts. It keeps the loan from defaulting on paper, but it masks the reality that the company is broke.
Jeff notes that Oaktree's non-accruals hitting 4.2% means even the PIKE trick isn't enough to hide the pain anymore.
So the trick has run its course. What happens when the bill actually comes due?
Jeff Snider points out that private credit mostly lends to middle market firms, the backbone of the economy. If they're failing, a recession isn't coming, it's already here.
Wait, so we shouldn't just look at the S&P 500 to see how we're doing?
Not according to Jeff. Large caps can hide behind massive cash reserves, but these smaller companies are feeling the interest rate squeeze right now.
It's the canary in the coal mine. When these private credit funds start reporting higher non-accruals, it means the real economy is gasping for air.
And Moody's just told us the canary is looking pretty sick.
Jeff also stresses that this isn't just an Oaktree problem. It's a systemic failure of the shadow banking transition.
Exactly. After 2008, regulations pushed risk out of big banks, but it just landed in these private funds that have less oversight and no lender of last resort.
So the risk didn't vanish, it just went undercover.
Exactly. And now that liquidity is drying up, we're seeing the results of that migration. Based on Jeff's analysis, Oaktree is just the first domino. He's predicting a wave of downgrades across other BDCs.
The pressure from higher for longer interest rates is systemic. If one fund is seeing a doubling of non-performing loans, others are likely sitting on the same mess.
So if I'm holding BDC stocks for the high dividends, I should be worried about those dividends getting cut.
Exactly. If they aren't collecting cash interest, they can't pay out those fat yields. Jeff thinks the income play is turning into a capital loss trap.
The market is starting to price in a harder landing than the soft landing narrative suggests.
Great, so my safe income portfolio might not be so safe after all.
Jeff predicts that as these credit issues surface, the soft landing consensus will evaporate, leading to a significant spike in market volatility.
The Fed might be forced to pivot, but if the credit market has already frozen, it might be too little, too late.
So we're looking at a much bumpier ride in 2025 than the mainstream media is reporting.
That's Jeff's view. The hidden leverage in private credit is the wild card that could trigger the next major downturn.
Jeff Snider's takeaway is clear. Stop watching the headlines and start watching the liquidity signals in private credit.
Keep an eye on tickers like OCSL. If their stock prices drop below their net asset value, it means the market doesn't trust their books.
So if OCSL keeps sliding, that's my cue that the credit crunch is intensifying.
That's the signal. It's a real-time gauge of how much stress is building in the hidden corners of the financial system.
Jeff believes this is the start of a broader contraction in lending, which will make the economic slowdown even worse.
Got it. Watch the private credit, watch the economy. Time to do some homework on my portfolio.
Today, we are dissecting a massive economic roundup from Adam Taggart, who just gathered insights from heavy hitters like Lacy Hunt, Ed Dowd, and Lin Alden.
The alpha here is clear. Despite the soft landing hype, these experts are signaling a major economic slowdown is already baked into the data.
Wait, so all those headlines saying we're fine are just noise? Lacy Hunt and the rest aren't buying it?
Not even close. While the S&P 500 looks shiny, Lacy points to a debt trap that's about to spring shut.
But hold that thought, because while Lacy is looking at debt, Ed Dowd is looking at a completely different disaster in the labor market that we'll get to in a minute. Adam Taggart highlights a massive gap between the stock market and the actual economy. Lacy Hunt's data suggests we could see a 2% contraction.
Exactly. Lacy argues that extreme debt levels act as a tax on future growth. You can't borrow your way out of a debt crisis forever.
2% contraction. That doesn't sound like much, but for the whole country that's huge, right?
It's the difference between a growing economy and a recession where people start losing jobs in droves.
And Adam notes that the lagging effects of interest rate hikes haven't even fully hit the system yet.
So we're basically waiting for the other shoe to drop, while everyone else is at the party.
Lacy Hunt's core argument in Adam Taggart's review is that federal debt is now over 120% of GDP.
And when debt gets that high, every new dollar borrowed actually produces less than $1 of economic growth.
Hold on, so we're spending money to get poorer. How does that even work?
It's called diminishing returns. You're just servicing the interest instead of building factories or tech.
Which leads Lacy to a shocking conclusion. We're headed for deflation, not the runaway inflation everyone fears.
Deflation? Like things getting cheaper? That sounds like a win for me.
Not if your salary and the value of your house drop even faster, my friend.
Now, Ed Dowd's take in the Adam Taggart discussion is even grimmer. He's looking at the silent recession in the labor market.
Right. Ed points out that while the headline jobs numbers look okay, full-time jobs actually decreased by 1.5 million over the last year.
Wait, 1.5 million full-time jobs just poof? Gone?
Exactly. They're being replaced by part-time gig work, which masks the real pain.
Dowd also mentions the impact of health issues and excess deaths on the workforce, which is a data point most economists are totally ignoring.
So the low unemployment rate is basically a house of cards.
According to Ed's analysis, yes, it's a statistical illusion.
Lin Alden brings a different angle to Adam Taggart's outlook, focusing on what she calls fiscal dominance.
She's tracking interest payments on the national debt, which are hitting $1.1 trillion annually.
Trillion with a T? That's more than we spend on the entire military, isn't it?
It is. Lin's point is that the Fed can't raise rates much higher without bankrupting the Treasury.
So the central bank is effectively trapped by the government's own spending.
So either they let inflation run hot, or the whole system breaks under the interest. Talk about a rock and a hard place.
Based on the consensus Adam Taggart has gathered, a massive Fed pivot is inevitable. We're looking at rates dropping below 3% by 2025.
But Lacy Hunt warns this won't be a good pivot. It'll be an emergency response to a collapsing economy.
Wait, so rates going down is actually a bad sign this time?
In this context, yes. It means the Fed is trying to perform CPR on a dying market.
And by then, the damage to corporate earnings will already be done. The experts in Adam's review are leaning heavily into long-term Treasury bonds. They predict they could outperform stocks by 15 to 20%.
If Lacy Hunt is right about deflation, those fixed income bonds become the most valuable assets on the planet.
So boring government bonds are the big winner. Who would have guessed?
In a crash, boring is beautiful. When everything else drops 40%, a 20% gain looks like a miracle.
It's the ultimate defensive play that Adam is flagging for his audience. The final takeaway from Adam Taggart's expert panel: cash is king again.
Suggesting a move toward 20% cash reserves ensures you have the dry powder to buy when everyone else is panic selling.
So I should just sit on my hands and wait for the fire sale?
Precisely. Patience is the most valuable asset in the Lacy Hunt playbook.
Watch those long-dated Treasury yields. When they start to plummet, you'll know the recession has arrived.
Got it. Cash ready, eyes on the bonds, and no more listening to the soft landing hype.
Today, we're diving into some heavy data from Nick Gurley, the CEO of Reventure Consulting, who says we are currently living through the biggest rental correction in United States history.
It's wild because Nick isn't just guessing. He's looking at apartment building prices, which have already plummeted 20 to 30% from their peak.
Wait, did you say 30%? That's not a correction. That's a total wipeout for some investors, right?
Exactly. Nick points out that while the single-family market is holding steady, the multifamily apartment sector is hitting a massive wall.
And here's the kicker. While apartment prices are crashing, Nick notes that a secondary wave is about to hit single-family homes, which we'll get into in a bit. According to Nick Gurley, the core problem is that we've built too much at the exact wrong time.
Right? He mentions that apartment supply is at a 50-year high, with nearly 1 million units currently under construction.
1 million? So there's going to be a for rent sign on every street corner soon?
Pretty much. Nick argues that when you flood the market like that, landlords lose all their pricing power.
It's a classic supply shock. Nick's data shows that in markets like Austin and Nashville, rents are already sliding fast. Nick Gurley highlights that many value-add investors who bought in 2021 and 2022 are now underwater.
They used short-term floating rate debt, and now those interest rates have doubled or tripled.
Hold on. So they owe more on the mortgage than the building is actually worth?
In many cases, yes. Nick says that because rents aren't growing anymore, these owners can't cover their debt service.
It's a recipe for forced selling, and Nick is seeing it start to play out in real time.
So the big money guys are actually the ones getting squeezed the hardest.
Nick points specifically to the Sun Belt as the ground zero for this correction.
Places like Austin, Phoenix, and Jacksonville are seeing rents drop by 5 to 10% in some neighborhoods.
Wait, I thought everyone was moving there. Why are the prices falling?
Nick explains it's because the supply growth is actually higher than the migration growth. They overshot the mark.
If you build 30,000 apartments and only 20,000 people move in, you've got a problem.
I guess that's good news for my rent, but bad news for the guy who owns the building.
Nick Gurley also raises a red flag about the banking sector's exposure to this crash.
Specifically, regional banks hold about $2.9 trillion in commercial real estate loans.
Trillion with a T. Should we be worried about our bank accounts?
Nick suggests it's more of a slow-motion train wreck for the banks than a sudden collapse, but it limits their ability to lend.
Exactly. As these apartment loans go bad, banks tighten up, making it harder for anyone else to get a mortgage. Nick predicts that the worst of the forced selling will happen in late 2024, as billions in loans hit their maturity dates.
The owners won't be able to refinance, so they'll have to either bring millions in cash to the table or hand over the keys. And
so we're looking at a huge going out of business sale for apartment buildings.
That's how Nick sees it. He expects prices to fall another 10 to 15% in the most oversupplied cities.
And when building values fall that far, the new owners can afford to charge much lower rents. What about the timeline for renters?
Nick Gurley's outlook is that rents will likely decline or stay flat for the next 24 to 36 months.
3 years of falling rent. Is that even allowed?
It's simple math, as Nick points out. It takes years for the market to absorb 1 million new units.
Until the vacancy rate drops back down, landlords will be competing for tenants with concessions and lower prices.
Nick's actionable advice is to keep a close eye on local vacancy rates.
He notes that once a city's vacancy rate crosses 7%, landlords start getting desperate.
So if I'm looking for a new place, I should check the vacancy rate first.
Exactly. Nick says that's your leverage to negotiate a better deal. For investors, Nick Gurley suggests patience is the best strategy right now.
The correction isn't over yet. He thinks better opportunities will appear once the distress really hits the fan.
So don't buy the dip yet? Wait for the crash?
Nick's data suggests we haven't seen the bottom. Keep your cash ready, but keep it on the sidelines for now. Let's kick this off with Matt deWolf's key thesis. He argues that the S&P 500 has hit a pivotal point.
That's right. Matt emphasizes the critical level at 588. If the bulls can't hold, a significant downturn is likely.
Wait, so we're talking about a make or break moment for the market? That sounds intense.
Exactly. It's a crucial indicator for traders right now. Next up, Gareth Soloway puts his focus on gold. He sees it breaking free from traditional constraints.
Yes, Gareth's insight is that gold is emerging as a strong hedge in these uncertain times.
So he believes gold is finally going to shine amidst all this chaos.
Absolutely. It's a classic case of asset reallocation towards something perceived as safer.
And then we have Doomberg, who takes a darker approach by highlighting the fragility of our interconnected markets.
That's right. Doomberg argues that surface stability masks underlying risks that could trigger a shock.
So, it's like we're all dancing on a tightrope over a pit of alligators. Sounds risky.
Exactly. Any misstep in these fragile networks could lead to sweeping consequences. Despite their differing approaches, a common theme among these guests is that market volatility is at an all-time high.
Right. Matt points to technical levels. Gareth is focused on gold, and Doomberg highlights market interconnectivity.
So they all basically say investing now is like walking through a minefield.
Yes, each has their lens, but they all stress the importance of vigilance. Another point of consensus is the turn towards alternative assets. Both Matt and Gareth see gold's importance rising.
Absolutely. Matt's analysis indicates gold's breakout potential, while Gareth believes it's a solid refuge.
Wait, so they're saying I should consider gold? No one talks about that at my coffee shop.
Yes, it's a significant trend in this economic climate. And there's also agreement on the unpredictability introduced by macroeconomic shifts.
Gareth and Doomberg both highlight that sudden market changes can alter sentiment overnight.
So, it's like trying to predict the weather with one of those old weather vanes. Sometimes they just point the wrong way.
Exactly, and that's why they stress caution in investment strategies. Now to where they clash. Matt sees this as a decisive moment for bulls, while Doomberg thinks we're on shaky ground.
Exactly. Matt argues that if the bulls hold, it's a comeback, but Doomberg suggests that's naive given how interconnected the systems are.
Wait, so one sees a recovery while the other sees impending disaster? Something's gotta give.
Yep, their analysis shows just how different perspectives can be under the same market conditions. Next, there's a disagreement on gold's outlook. Gareth is optimistic about gold's trajectory, while Doomberg issues caution.
Gareth believes gold is set for a recovery, yet Doomberg warns that market complexities could undermine its safety as a hedge.
So Gareth is like, invest now, and Doomberg's like, not so fast. There are odds.
Precisely. This illustrates how investment strategies can diverge based on underlying assumptions. Finally, we see a clash between technical and fundamental approaches. Matt trusts in chart signals, while Doomberg looks at overarching macroeconomic trends.
It's a classic battle of analysis techniques. Matt is all about those technical indicators, while Doomberg's grounded in fundamental risks.
So it's like they're each reading different maps to get to the same place.
You got it. Both perspectives are valuable, but lead to conflicting conclusions. Thanks for tuning in. If you found these contrasting insights helpful, give us a thumbs up and hit that subscribe button.
We're committed to bringing you the sharpest financial analysis and roundups from leading experts.
Honestly, this was eye-opening. I'm definitely subscribing to catch the next ones.
Stay tuned for our next episode, where we'll dive even deeper into the market's latest trends.